Do you want to buy a home but are not exactly sure where to start? Well, I'm going to cover everything you're going to need to know before buying your first property. Now, buying your first home can feel like an emotional roller coaster. There's a lot of excitement involved, but there's also a lot of fear and uncertainty. You'll be moving into a new place, and if you're getting a mortgage, you'll also be borrowing hundreds of thousands of dollars. For most people, purchasing a property is going to be the largest investment that they'll ever make. So if you're feeling stressed out or overwhelmed, just know that that's completely normal. I'm going to walk you through the 5 major steps everyone takes before buying their first property. So no matter if you're just thinking about buying a home one day out in the future, or if you're ready to buy a home right now, this video is going to walk you step by step through everything you're going to need to know to buy your first home. And if you have any specific questions about buying a home, message me down in the comment section and I'll do my very best to answer any questions you may have. There are many benefits to owning your own home. First, no more paying rent. You'll also never have to relocate because the landlord is asking for the apartment back. You'll also watch the value of your home appreciate over time because buying a home is an incredible wealth building tool. You'll be building up your own net worth as you watch the equity of your home increase over the years. There are also some big tax advantages of owning your own home. The interest you pay on the mortgage and your property taxes are both tax deductible. This means homeowners are rewarded by paying less in taxes compared to renters making the same amount of income. You'll also have the option of one day renting out your property and collecting rent as an additional source of income. Now, home prices have continuously increased over the past 10-15 years, so it's now more expensive than ever to buy a property. And many people get discouraged because the home of their dreams is outside of their budget. So I want to introduce the idea of something called a step-up home. A step-up home is the type of property you buy today because you can't afford your dream home yet. You see, buying a home does many things. It's a chance to start saving money by stopping the cycle of paying rent year after year after year. Let me tell you my step-up home story. After a bad breakup in my early 30s, I had to move back in with my parents for about a year. Once I was able to think clearly, I decided to buy my first home. So when I started the search, the best property for me to buy was a tiny 200 square foot condo in Bronxville, New York. The condo was in a great location and it came with parking. But of course, the big problem was that it was only 200 square feet, which was tiny. But I knew that I wasn't going to be there forever. So I bought it for $68,000. My mortgage and maintenance came out to about $500 a month, which allowed me the opportunity to keep saving money. A few years later, I met my future wife and we decided to get married. So of course, we couldn't live in a tiny 200 square foot apartment. I had to sell my condo and buy a 1-bedroom co-op in Yonkers. I sold my condo for $11,000 more than I purchased it for. That, along with my savings, I was able to put down 20% and buy my new apartment. Now, if I didn't buy that condo and I wanted to move out of my parents' house, I would have probably ended up paying rent around $1,500 a month, which would have made it almost impossible for me to save up as much money as I actually did. You see, that studio allowed me to buy the next apartment. Now, I'm telling you this story because I speak to a lot of buyers that tell me that if they can't afford their dream house today, that they're just going to continue renting. But what they fail to realize is that many times, not always, but many times, those same buyers that own those big, beautiful houses started by buying a co-op. And after years of saving, after watching their equity increase over time, by saving and making smart financial decisions, they were finally able to afford their dream home. It's almost always better to start sooner than to wait, because if you continue to wait, you may be waiting forever. Okay, so let's begin. Now, most real estate agents are going to tell you that the very first step in buying a property is to get pre-approved with a bank. But I think that's wrong. I think step 1 is actually what I call the pre-purchase preparation, which is to understand how the pre-approval process even works. Because once you understand how banks qualify you, then getting pre-approved doesn't seem so overwhelming. Once you understand how the pre-approval process works, then you can decide for yourself if it's the right time to go speak to a bank now or if you have to wait. So I'm going to break down what banks are looking for to pre-approve you. Obviously, banks that are lending you money want to minimize their risk of losing money. So they have these certain requirements that you must meet in order for them to lend you money. Now, as time goes by, banks adjust these requirements because they're in the business of lending money to make money. So if they can loosen up the requirements and still make a profit, well, that's what they're going to do. So these requirements could change over time, but generally speaking, this is what banks are looking for. The banks are going to take your annual gross income, that's your income before they take out any taxes, to see what you qualify for as far as what your maximum housing payment is going to be. They use something called a debt to income ratio. So depending on which loan program you qualify for, each program has their own maximum debt to income ratio. So I put together this worksheet called the maximum mortgage amount worksheet. And what I did is I'm going to walk you through, I'm going to fill out this worksheet as I walk you through the example. And so if you want to get a copy of the worksheet, along with a checklist of all the documents the bank is going to require to issue you a pre-approval, there's a link down below in the description. Click on the link and download your own worksheet for free. And I'll go over the most popular ones later on in this video. But let's use conventional mortgages for this example. A conventional mortgage can qualify you as a maximum debt to income ratio of 49% of your gross monthly income. So what does that mean? Let's use an example that you make $8,000 a month before taxes are taken out. You multiply 8,000 by 0.49 to get your maximum debt to income ratio payment. So 8,000 times 0.49 comes out to $3,920. So that's the maximum amount of payment that the bank can let you carry in order for you to qualify for a mortgage. The bank then looks at your credit report and reduces that $3,920 number by any minimum monthly payments that you have on other debts. So let's say you have a credit card and a car payment, and the minimum payments on both those are $500 a month. They'll take that $3,920 number and subtract it by 500, which will give you a payment of $3,420. Next, they factor out the property taxes and or maintenance fees. So let's say the property you're planning to buy has a monthly tax bill of $700 a month. They take the $700 and subtract it from the $3,420, so you're left with $2,720 as a monthly payment that you can afford. Then they look at the current interest rate. Let's say the current interest rate on the mortgage you qualify for is 7.25%. If the bank lends you $400,000 at 7.25%, your monthly mortgage payment is going to come out to $2,720 a month. And that is going to be the maximum amount of money that the bank can lend you. You take that loan amount, add it to your down payment, and that's the total purchase price that you qualify to buy. So now that you understand how debt to income ratios work, you can now take your monthly income and figure out how much money the bank is going to lend you. Again, you have to account for any debts that you may have that can show up on your credit report and the property taxes or maintenance bills that come along with the property. And if this kind of all went over your head, don't worry about it. This is actually your loan officer or banker's job to do. They're the ones that are going to collect your tax returns and take a look at your pay stubs and kind of figure out how much money the bank is going to lend you. But you do want to have a very good idea of how they came up with that number. Now, when you buy a property, you're going to want to have a high credit score to qualify for the best interest rate possible. Now, the minimum credit score to get an FHA mortgage is 500. But with a score that low, the bank requires you to put a larger down payment of 10%. And the lower your credit score, the higher interest rate the bank is going to want to charge you. For an FHA mortgage, if your credit score goes above 580, you then qualify for a 3.5% down payment. And on a conventional mortgage, if your credit score is above 760, you qualify for the lowest interest rates possible. The next thing the banks are going to want to see is that you've been steadily employed for at least 2 years. So they're going to ask you for your tax returns, W-2s, and current pay stubs to verify that you're currently working. They also can't see that you have collected any unemployment for the past 2 years. Many banks will allow you to receive a gift for the closing costs and down payment money, but they're going to want to see proof of this. They're going to want to see evidence, so you may have to provide a gift letter from the person that's gifting you the money. Now, closing costs tend to be between 4 to 6% of the purchase price of the property that you're buying. And this goes for single family, multifamily, and condos. For co-ops, closing costs are much less, and they average around $5,000 to $6,000. Now, let's get back to down payments. Most mortgage programs will require you to put down a certain amount in down payment in order for you to qualify for that mortgage. And you could always put more money down if you want, because the more money you put down, the less money you're borrowing, the less your monthly mortgage payment is going to be. The ability to save money is a filter to see if you're ready to buy a home or not. Now, having said all of that, one of the most common questions I get asked is that are there any special programs for first-time home buyers that can help with down payment or closing cost assistance? These programs can either come from the bank that's lending you the money, or they can come from a local nonprofit organization. Now, if these programs are offered through the bank, you need to speak to your bank to get more information about the programs that they're offering. And different banks have different incentive programs all the time. So you need to speak to your loan officer to get the latest information about what they're currently offering. And if the program comes from a nonprofit organization, you need to go to the organization in the area where you're purchasing your property. I work in New York, so in my market there are two nonprofit organizations. The one in Westchester is called Westchester Residential Opportunities, and the one in the Bronx is called Neighborhood Housing Services. And these programs work by county. So if you're planning to buy a home in the Bronx, you need to go to the Bronx office. If you're planning to buy a home in Westchester, you have to go to the Westchester office. I've seen plenty of people that start in Queens and then they end up buying in Westchester, and then they find out that the program that they took a class for doesn't qualify to buy outside of the area where they took the class. These organizations offer classes, workshops, and have the latest information on any federal or local grants that are being offered to first-time home buyers. By the way, if you found this information useful, be sure to click on the like button because that really helps us grow this channel. And if you want to see more videos just like this, make sure to subscribe to our channel as well. Okay, let's go on to step number 2, which is actually applying for the mortgage. So once you've collected all your documents, your bank statements, your tax returns, your current pay stubs, all of that information, once you have all of that, you submit it to the bank takes a look at it and issues you a pre-approval letter. Now, getting that pre-approval letter is going to provide you with a lot of useful information. First, you're going to know what your maximum purchase price is going to be because the pre-approval letter will tell you how much money the bank can lend you. You're also going to get an estimate of what your monthly mortgage payment is going to be so you can decide for yourself if you're comfortable with that payment or not. The bank is also going to let you know how much money you're going to need for down payment and closing costs. So instead of dealing with hypotheticals of it should be around this, you can qualify for that, you'll actually have real numbers to go by. Now, part of the process of getting pre-approved is that your banker is going to help you figure out which is the best mortgage program that you qualify for. Now, most loan officers have access to the most popular mortgage programs. And depending on what area you live in, there might be specific programs that only apply to your area. But here are the major ones for most markets. Now, conventional mortgages are technically private bank loans, but they're resold back to the government through two programs called Fannie Mae and Freddie Mac. So after the mortgages are issued, if they meet certain guidelines, the government has agreed to buy them back. These mortgages typically require a minimum credit score of 620. Now, some banks will issue a conventional mortgage with a 3% down payment, but most banks want at least 5% down payment. With a 5% down payment, you are going to end up paying something called private mortgage insurance, otherwise known as PMI. And I'll get to PMI later on in this video. And the maximum debt to income ratio on a conventional mortgage is 49.9% on a back end ratio. Another type of popular mortgage is the FHA loan. FHA loans are excellent for first-time home buyers with small down payments or low credit scores. The FHA mortgage program requires a 3.5% down payment if your credit score is at 580 or above, or a 10% down payment if your credit score is between 500 and 579. So these mortgages are great for people that don't have perfect credit. FHA loans also have a more flexible debt-to-income ratio requirement. You can go up to a 56% back-end ratio and still qualify for this type of mortgage. But there are some negatives to getting an FHA mortgage. FHA requires that the property meet FHA appraisal standards. This means that small conditional issues with the property can delay financing, such as chipping paint or maybe there's a handrail missing. So unless these minor issues get fixed, FHA will not finance your mortgage. So this causes a lot of delay and a lot of stress and grief at the last minute right before you're getting ready to close. And this is because after weeks of being in contract, once the appraisal report comes back, it could say something like the chipping paint in the basement needs to be gone in order for us to issue a mortgage. And at that point in time, most of the time the sellers just want to get out. They don't want to have to deal with any more repairs to the property. But according to FHA guidelines, this has to be fixed in order for them to issue a mortgage. FHA also charges the buyer something called upfront mortgage insurance premiums. Now, this is an insurance policy that the bank forces you to buy for not putting down a 20% down payment on the property. This is a way for the bank to minimize the risk of allowing you to buy a property with less than 20% down. So as a buyer, you're going to pay a premium upfront when you buy the property, and then you're also going to pay something called a mortgage insurance premium every month for the rest of the life of the mortgage. Now, if you were to get a conventional mortgage and put down less than 20%, you'd also be required to get mortgage insurance on your mortgage. But that mortgage insurance disappears once you have 20% equity in the property. So once the loan to value goes below 80%, the mortgage insurance disappears. But with FHA, that mortgage insurance lasts for the lifetime of the mortgage. Another very popular mortgage program is the VA mortgage. VA mortgages are issued by the Department of Veterans Affairs. To be eligible to get a VA mortgage, you either need to be a veteran, be in active duty, or be the spouse of a service member. One of the biggest benefits to getting a VA mortgage is that it does not require you to have a down payment. It's 100% financing. And they typically offer lower interest rates compared to conventional or FHA mortgages. VA mortgages also have more flexible credit requirements. So you may need a credit score between 580 and 620 to qualify, depending on which bank you go to. Another huge benefit of getting a VA mortgage is that these mortgages don't have mortgage insurance premiums. So even if you're not putting down a 20% down payment, you're not required to pay for mortgage insurance. But one of the negatives that I have seen with VA mortgages is that just like FHA mortgages, there are stricter requirements on the appraisal. So if the home is not in nearly perfect condition, sometimes an appraisal is done and the seller is required to do minor repairs on the property before they can issue a mortgage. Now, I just reviewed some of the most common mortgage programs out there. There are others, like in New York State, there's something called a Sony Mae loan, and there's also something called a NACA mortgage. Now, these programs are not as popular as the other ones, but it's really up to your loan officer to kind of review all your documents and let you know which are the best programs that you qualify for. But I still think it's very important for you to understand that there are different programs out there and there are benefits and disadvantages to each and every one of them, so that way you can have an intelligent conversation with your loan officer and ask them, why did you go with this program instead of this program? Why am I not eligible for this type of mortgage? Now, once you've obtained a pre-approval letter and know which mortgage program you'll be going with, you're finally ready to start looking at homes. So there's two types of searches to do. One is doing online searches where you'll be viewing properties online, and another is when you're actually going to be going to the properties and seeing them in person. So as you're looking at properties online, you'll kind of figure out what the price range is for the type of property that you're looking to buy. And you'll see that there are three big variables when it comes to pricing: location, size, and condition. So of course, the biggest house in the best condition, in the nicest neighborhood, is gonna cost the most amount of money. And if you can afford it, great. That means you can buy the home of your dreams today. But if you're like most first-time home buyers, you're probably gonna be working within a budget. So you're gonna have to balance out those three factors: location, condition, and size, based on your budget. Now, most buyers have a really hard time identifying what they want, but they have a real easy time identifying what they don't want, and that's pretty normal. As you look at homes and through the process of elimination, you'll identify the price range of the type of property you're looking to buy. You'll then identify if you can afford the type of home that you're looking to purchase or if it falls outside of your budget. I'll give you an example. Currently, my wife and I are looking for a 2-bedroom co-op to buy in Lower Westchester, and we figured that our budget should be around $2,200 a month. This will give us $1,200 for maintenance and around $1,000 for a mortgage payment. But what we've been seeing is that there are very few properties to purchase in Lower Westchester. So what we're doing is we're expanding the location in where we're looking. Another option would be to buy a property that is not in as great of condition, because we're also okay buying a property if it needs a little bit of renovation. What we're not willing to do is buy a small apartment, because the whole purpose of buying a 2-bedroom apartment is to get more space. So there's no reason to buy a small 2-bedroom apartment. So we're willing to compromise on location and we're willing to compromise on condition, but we're not willing to compromise on size. So if the home that you're looking for is currently outside of your budget, these are the three factors that you're gonna have to play with. And whatever you decide is completely okay, because at the end of the day, this is your property. It means buying this home means more to you than anyone else. So you get to decide on what you are willing to and what you're not willing to compromise on. And as you become more and more familiar with the market, you may realize there are some things that you change your mind on. There might be some things that you thought were really important in the beginning and they turned out to be not so important, and vice versa. And that's 100% okay. It's a very normal thing to do as you're searching for homes. Another major decision you'll make around this time is whether or not you want to work with a real estate agent. And this is completely your decision. Some people like having a professional there to answer questions, to schedule showings, to make the process as smooth and as simple as possible, and other people want to do it by themselves. But here are some factors to consider. Number one is market expertise. Now, if you're really familiar with the area that you're looking to buy, then you're the expert. But if you're not familiar with the area, then having a real estate agent there to guide you is going to be super helpful. I'll give you an example. There's one neighborhood in the Bronx called Pelham Parkway, and there's a specific street in Pelham Parkway where the houses across the street tend to sell for 20% less than the houses on the other side of the street. Now, if you're not familiar with the Bronx, or if you don't know Pelham Parkway, you have no idea what street I'm talking about. Because if you're buying a home in Pelham Parkway and you happen to buy a house on the other side of the street, and by the way, these homeowners are trying to get as much money as they can, so they don't mind overpricing their house. And if you look at the comparables and you say, well, I see that the houses in this area are selling for $750,000. And if you make an offer like that on a house that's on the other side of the street, well, now you've just lost 20% of your equity. And you may not ever know about this until it's too late. Another big reason why you may want to hire a real estate agent is to help you save time. You see, if you don't hire a real estate agent, you're the one that's going to have to be making the phone calls to schedule the appointments, talking to multiple real estate agents, and going through their screening process of what they require you to do before scheduling a showing. So some people just don't have the time or the patience to do this, so they find it really beneficial to hire an agent to help them schedule showings. So obviously, by not hiring an agent, you don't have to pay a commission, and that can help you save money. But you can only save money if you get a lower sales price, because if you pay a really high price for the property that you're buying, how is that saving any money? And a real estate agent is there to help negotiate on your behalf to negotiate a lower sales price for you. So if you don't hire an agent, then this becomes your job to take over the responsibilities of negotiating and trying to get the best price possible for your home. At the end of the day, it comes down to personal preference. Some buyers do like having someone there to talk to answer questions, to help schedule showings, and to submit the offers and negotiate on their behalf. And other buyers just feel a lot more independent and they want to do things on their own. Either way that you do things, it's completely up to you. So if you are going through the home buying process and want to be connected with a high quality agent, definitely reach out to me. I belong to several networks of high quality agents that work all across the country, and I'll surely be able to help you find a high quality agent that works in your area. My contact information is down below, or you can reach me directly at 914-386-2289. So now, after you've seen several homes, you're gonna see one that you really like. That'll bring us to step 4, which is making an offer and negotiating. Now, normally when I work with a buyer, we only see anywhere between 5 to 10 properties before we see the perfect one that they want to purchase. And that's because we've seen many more homes online and we only go see the best ones in person. So when you found the right home, now it's time to make an offer. And an offer is more than just the price. It's the price and the terms of the sale. So the terms of the sale include if you're getting a mortgage, if you're planning to do an inspection, if you want the homeowner to do any repairs on the property before you buy it, or if you're willing to buy the property with any tenants in there, or if you want the house delivered vacant. All these extra terms have to be included in with your offer. The seller then receives your offer and they have 3 choices. They could either accept it, reject it, or give you a counteroffer. Now, most of the times the counteroffer has to do with price, but it could also be part of the terms. So whatever it is, both parties need to go back and forth until there's a mutual agreement on both price and terms. If both parties agree on price and terms, now we have something called a verbal accepted offer. Now, the process of buying real estate changes depending on where you are at in the country. What I just described to you is the process that we use here in Westchester and Bronx County, New York. So if you're in a different part of the country, things may be done a little bit differently. In some areas, the buyer signs a contract and sends a down payment as their offer. And if the seller agrees to accept it, they sign the contract, and now you're officially in contract immediately. In New York, things go a lot slower and it takes a lot more time to go into contract. But let's get back to the way things are done here in New York. So after there's been a verbal accepted offer, it's normal that the buyer pay for a home inspection to be done within 1 to 3 days of getting their offer accepted. The buyer pays anywhere between $600 to $800 to have a home inspector come do a thorough analysis of the condition of the property. And then they issue a report explaining everything that's wrong with the house. So after the inspection is issued and the buyer reviews the inspection report, the buyer has one of 3 options. Number 1, they could decide to move forward with the sales under the original agreement. Number 2, they could say, you know what, I don't like this house. The inspection was terrible. I want to just cancel everything. Or number 3, they could try to renegotiate either for a credit or for repairs on the property. As a real estate agent, I always try my best to keep the sale going by trying to find a middle ground between what the buyers want and what the seller's willing to do. From the buyer's perspective, this is a highly emotionally charged period. They're about to sign a contract and sign a huge down payment check over to the seller's attorney. So the inspection phase is the last time they'll have that they can change their mind about buying the property. So renegotiating for terms, price, or repairs is very normal. So this is the advice I give to buyers after the home inspection. If we're offering the seller a fair market price on the property, a very good price, we can expect to receive the house in working condition. So anything on that inspection report that was damaged or broken, we could ask the seller to repair by the time of the closing. What most sellers are unwilling to do, however, is do cosmetic upgrades or replace systems for things that are currently working. This means that even if the boiler is 20 years old and is towards the end of its life expectancy, we cannot expect the homeowner to replace you and give you a brand new boiler just because you think that the boiler may not work in the future. So we can always ask for a credit to help you reduce the cost of when you will have to replace the boiler. But the seller is not required to give it to you, and you're not required to buy the home. If both parties cannot come to a mutual agreement, then the sale falls apart, the buyer loses the money they paid for the inspection, and the seller loses his time in dealing with you instead of trying to sell the property to somebody else. However, if after negotiation, both parties are willing to move forward with the sale because everything's been agreed to, you're finally ready to go into the final step, which is signing a contract and going from contract to closing. And after you've signed the contract and gave over a down payment check, next the seller signs, and then once the seller signs, you're officially in contract. Congratulations, you've made it this far in buying a property. Now, there are still some major steps to go, but you've come a very long way if you got into the step of being under contract. So when you're in contract, both parties have agreed to do certain things to work together towards a mutual sale. From the buyer's perspective, you've agreed to submit an application to a bank and give the bank all the documents that they need in a timely manner to get an approval on a mortgage. The banker then takes your documents and goes through 3 screening processes. First, the loan officer looks at the paperwork, then the processor looks at the paperwork, and then finally an underwriter looks at the paperwork, all before they can issue what's called a commitment letter. Now, if the buyer does everything they agreed to do in the contract and they still can't buy the property through no fault of their own, the contract is canceled and they get their down payment check back. So here are some reasons that a buyer may not be able to close on the property. Number 1, they can get a denial letter from the bank. The bank could look at all the documents and they could say, you know what, we're gonna have to deny this mortgage. We thought you could get a mortgage in the beginning, but after further investigation, after reviewing all your documents, you actually don't qualify for the loan. The contract is canceled and you get your deposit back. Another thing that could happen is that if the property underappraises, let's say you signed a contract for $750,000, the bank sends an appraiser out there and says that the house is only worth $700,000. At this point, both parties could agree to renegotiate the price and the terms of the sale, and if they can't come to a mutual agreement, then the contract is canceled and you get your deposit back. There also might be title issues that can prevent the sale from going through. Also, a seller may not be able to complete his side of the agreement to sell the property. I'll give you an example. In New York, a standard contract reads that the seller is going to sell the property free and clear of any violations or open permits. So if the seller signs this contract, then he can't sell the house with any open permits or violations. He may not even know there's a violation on the property. When they run a title report, a violation may pop up, and the seller may refuse to get rid of it. He may say, you know what, this is a big problem. I don't want to deal with it. I don't want to do anything. Well, in that situation, if the seller has signed a contract saying that he'll remove the violation and he doesn't want to do it, then the buyer is not obligated to purchase the property. The contract can be canceled and the buyer can get his money back. Another example of this could be if the buyer and the seller agree to buy the property vacant. So in this situation, let's say there's a tenant living in the property, and now the seller agrees to sell the house empty. And let's say we're getting ready to close and the tenants are refusing to move out. Well, in that situation, you signed a contract saying that you wanted the house to be delivered vacant. There's a tenant there. The seller can't make the tenant move. And so at that point, the buyer has the option of canceling the contract and getting their money back. Now, when going through the mortgage process, there are 3 major checkpoints that the buyers go through. Number 1 being the appraisal. The appraiser comes out, inspects the property, and issues a report. The report then justifies the value of the sales price and looks at the condition of the house and says that everything is okay. So having the appraisal completed with no issues is checkpoint number 1. Checkpoint number 2, which is also really important, is when the bank issues a commitment letter. A commitment letter is a promissory letter from the bank saying that they are going to give you the mortgage as long as you meet all the final conditions by the time of the closing. Once a commitment letter is issued by a bank, you're like 99.99% guaranteed to close on the sale of the property. And the final checkpoint is called a clear to close. Now in New York, because we don't do anything easy, there's actually 2 clear to closes. The bank issues their first clear to close, and then they send the file to a bank attorney who reviews everything one last time and says, okay, we're good to close. And that's the bank attorney that calls the buyer's attorney to schedule the final closing. And once your lawyer receives that phone call to schedule a closing, congratulations, you're almost at the finish line. But there's just one more thing that needs to happen, and that's called a final walkthrough. A final walkthrough is done within the last 48 hours before the closing, where you walk through the property one last time to make sure that everything is in the condition that you wanted it to be for the closing. Now, if there's anything that shows up at the final walkthrough, let's say you try to turn on the lights and the lights don't turn on. Well, then what's going to happen is that they're going to look at the contract and see if having functioning electricity was part of the agreement, which it normally is. So if the seller agreed to sell you the property with functioning electricity, and now you don't have functioning electricity, now the seller is responsible for turning on the electricity or issuing you a credit for not having the property be in the condition that was agreed to in the contract. So once the walkthrough is done, you look at the property. If anything comes up, you discuss it with your lawyers. If everything is okay, you go to the closing. Congratulations, you've bought your first property. Now I know I gave you a ton of information, but if you have any specific questions, my contact information is down below. Please feel free to reach out to me with any specific questions you may have about buying a home. Thanks so much for watching. Have a great day.